I am sitting here in my office in Omaha, Nebraska, looking at a set of numbers that would terrify the average investor. But for me, they simply confirm a reality that the rest of the world is trying desperately to ignore. It is quiet here, but outside these walls, out in the frenetic digital landscape of Wall Street and the global exchanges, the first violent winds have already stripped the roof off the global economy. I am watching something I have not witnessed in nearly 2 decades, and frankly, it has captured my absolute attention in a way that very few market conditions have since the catastrophic Dottie. We have just witnessed the opening act of what I firmly believe will be remembered by historians and economists. Consider the evidence that is staring us right in the face in November 2025 alone. We watched the Dow Jones Industrial Average plummet 798 points. In a single trading session, we watched the Nasdaq crater 23%. These are not normal fluctuations. These are not the healthy breaths of a growing market. We are watching consumer sentiment hit lows that we have not seen since the absolute depths of the Great Recession, a time when the entire global financial system stood on the precipice of total collapse. But here is what is truly keeping me up at night. Here is the thought that lingers when I turn out the lights. This is not just another standard correction. This is not a buy the dip opportunity. The Standard & Poor's 500 is currently trading at a forward price to earnings ratio above 23. That is a valuation milestone that has appeared exactly one time in the past 25 years. Do you know when that was? It was right before the market lost a quarter of its value. My own company, Berkshire Hathaway, is currently sitting on a record-breaking historic pile of cash. $382 billion. Let that number sink in. $382 billion. People look at that number and they ask me, Warren, have you lost your touch? Have you forgotten how to find good businesses? Why are you sitting on the sidelines when the market is roaring? The answer is simple, cold, and mathematical. It is not because I have forgotten how to find good businesses. It is because at these prices, in this environment of euphoria and delusion, there simply aren't any good businesses to buy. Let me walk you through the mathematics of this disaster. These are numbers that should concern every single investor reading this or listening to my voice. There is a ratio I have used for decades to gauge whether stocks are reasonably priced or dangerously expensive. People have come to call it the Buffett Indicator. It is a simple, elegant metric. It compares the total market capitalization of all United States stocks, the value of every public company in America combined. It measures the price of the market against the actual economic output of the nation. When I first started talking about this metric back in 2001, I mentioned that it was probably the best single measure of where valuations stand at any given moment. It is the thermometer for the market bee fever right now as we sit here in late 2025. That indicator sits at approximately 200%. I want you to read that again, 200%. The entire stock market is valued at twice the size of the entire American economy. This is the highest level since 1947. It is not just high, it is unprecedented. It is an 100% figure into a terrifying perspective. Let us look back at history. During the absolute peak of the dot-com bubble in the year 2000, when people were quitting their jobs today, trade, tech, stocks, and companies with no revenue were worth billions. This ratio hit around 140%. We all remember what happened next. The Nasdaq lost 78% of its value. Over the following 2 years, trillions of dollars of wealth evaporated into thin air. Families were ruined. Retirements were destroyed. And that was at 140%. In 2008, just before the financial crisis that nearly broke the world, the ratio was around 105%. Today, 200% reading is not just a warning sign. It is not a yellow light. It is a siren blaring at full volume in a burning building while most investors are standing in the lobby with their fingers in their ears, pretending they cannot smell the smoke. But that is not the only troubling metric flashing red on my dashboard. The Standard & Poor's 500 cyclically adjusted price to earnings ratio, known as the CAPE ratio, developed by the brilliant known as the CAPE. This is not some minor elevation above historical norms. This is stratospheric. The index has only achieved a monthly CAPE ratio above 39 during one singular period in its entire 68-year history. The dot-com bubble from January 1999 through November 2000, that is right, just 22 months out of 826 total months. We are currently sitting in the 97th percentile of valuations. The market has only been this expensive about 3% of the time since the index was created in 1957. And history shows us exactly brutally what happens after these extreme valuations. They're REITs. Over 2 years, it was deeply negative. Over 3 years, the index fell approximately 30% now. I am not saying history repeats exactly. History is not a photopotier. But as Mark Twain supposedly said, history often rhymes, and right now the market is rhyming in perfect, terrifying meter. The rhythm is identical, and the crash will likely be identical. Let us talk about what I have been doing at Berkshire Hathaway, because in this business, actions speak louder than any prediction, tweet, or interview. In the year 2024, when everyone was celebrating the bull market, we sold $134 billion worth of equity. That is not a typo, $134 billion. We liquidated. We got out our cash pile nearly doubled in a single year, reaching $382 billion by the third quarter of 2025. For the past 3 years, Berkshire has been a net seller of stocks every single quarter. I haven't suddenly become pessimistic about America or its businesses. I am still as optimistic as ever about this country's long-term prospects. I believe in the American spirit. I believe in American ingenuity, but I am not willing to pay prices that make no mathematical sense. I am not willing to light my shareholders' money on fire to participate in a mania. The most dramatic example of this discipline was our decision to sell a majority of our Apple stake. We started building that position in 2016 when Apple was reasonably priced and growing into a phenomenally valuable franchise. It was a great business at a fair price. By 2024, it had become our largest holding, representing nearly half our equity portion. A lot of people questioned that decision when we first announced it. They called me old-fashioned. They said I didn't understand the new tech cycle, but after the April 2025 tariff crash, when $2 trillion in market value evaporated in a single day following a presidential, people ask me all the time, Warren, if you are so bearish, why haven't you sold everything? Why do you still hold any stocks at all? I am not bearish, I am realistic. There is a fundamental difference that most people fail to grasp. It means understanding that paying $3 for something worth $1 is a bad deal. No matter how exciting the story sounds, no matter how many people tell you it is the future at Berkshire, we have always kept most of our money in equities because we believe in American business over the long term. But that does not mean we will pay any price. As my late partner Charlie Munger used to say, a great business at a fair price is far superior to a fair business at a great price. Right now, we are being offered mediocre businesses at astronomical prices, and I am just not interested. Provides the clearest, most vivid example of this valuation insanity. Take Palantir Technology is a company that provides data analytics software. As of November 2025, Palantir is trading at a price-to-earnings ratio between 406 and 511, depending on which metric you use. Its forward price-to-sales ratio. Let me explain what that means in plain English, stripped of the Wall Street jargon. At current prices, it would take more than 100 years of Palantirian projected revenue, not profit but revenue, to equal its market capitalization. The Economist recently published an arm of all time. That is not my characterization. That is coming from one of the world's most respected conservative financial publications. Even NVIDIA, which has built a genuinely impressive business supplying the chips that power artificial intelligence, insisting NVIDIA is a real company with real profits and real competitive advantages. It is not a smoke and mirrors operation. But at 53 times earnings, you are paying for perfection. You are assuming that nothing goes wrong. You are assuming that competition never catches up. You are assuming that government regulations don't interfere. You are assuming that the artificial intelligence boom continues unabated for years. Any of those assumptions could prove wrong. This brings me to a concept I have been hammering home for decades: margin of safety. When I buy a stock, I want to purchase it for significantly less than what I believe it is truly worth. That gap between price and value, that is your margin of safety. It is your cushion against the inevitable misakti. When stocks are priced 50, 100, or even 400 times earnings, there is no margin of safety. There is barely a margin of insanity. You are walking a tightrope without a net over a canyon in a hurricane. One gust of wind, one disappointing earnings report, one competitive threat, one regulatory change. The crash has already begun, though most people do not realize it yet. We are in the early innings of a long, painful game. In April 2025, President Trump's Liberation Day tariff announcement triggered the worst market decline since the 2020 COVID crash. The Standard & Poor's 500 plunged 10% in just 2 trading sessions. The Nasdaq briefly entered bear market territory. It was violent. It was fast. Then in October, another presidential social media post about increasing tariffs on China wiped out $2 trillion in market value. In a single day, the Standard & Poor's fell 2.7%. The Nasdaq dropped 3.56%. These were panic selling episodes. These were moments where liquidity vanished and fear took over. The market recovered somewhat after each crash, leading many investors to believe the worst was over. "It's just a blip," they said. "Buy the dip," they screamed. That is exactly the same pattern we saw in 1929, after Black Monday in October, when the Dow plunged 13% in one day and another 12% the next. The market actually rallied through November and into early 1930. People thought the crisis had passed. They thought they had survived the storm. They were wrong by May. Stocks had fallen 79% from their 1929 peak. I do not have a crystal ball, but I am saying that initial crashes are often followed by rallies that lure investors back in before the real damage occurs. It is the sucker's rally. It is the trapdoor opening beneath your feet just as you think you are safe. Unsown confidence has fallen off a cliff. And this is perhaps the most overlooked danger sign in the current market. The University of Michigan Consumer Sentiment Index recorded a preliminary reading of 50.3 in November 2025. That is the second worst result in the index's nearly 5-decade history. Think about that for a moment. We have been through oil crises, stagflation, recessions, the savings and loan crisis, the dot-com bust, 9/11. And consumer sentiment right now is worse than almost all of those periods except one. Why does this matter? Because consumer spending represents roughly 2/3 of America's gross domestic product. When consumers feel pessimistic about their financial futures, they pull back on spending. Corporate revenues decline. When earnings fall, stock prices are already overvalued at 39 times earnings. Have nowhere to go but down is a downward spiral, a feedback loop of negativity. The inflation picture makes this even more concerning. Consumers expect inflation to hit 4.7% over the next 12 months, well above the 5-year average of 4.1%. Besides the Federal Reserve's efforts to control price increases, people are experiencing persistent inflation in their daily lives. They feel it at the grocery store, at the gas station, and at the doctor's office. Real wages, adjusted for inflation, have been essentially fat. For many workers, this is not a sustainable foundation for continued economic action. I have lived through enough market cycles to recognize the pattern of denial that precedes every major crash. In 1999, anyone who suggested technology stocks were overvalued was dismissed as not understanding the new paradigm of the internet economy, traditional valuation. Companies that had never earned $1 of profit were trading at market capitalizations larger than established industrial giants. When I stuck to buying businesses I understood at reasonable prices, Berkshire dramatically underperformed the market in 1999. People wondered if I had lost my touch. They wrote articles asking. The next year, the Nasdaq collapsed. And suddenly, those old-fashioned valuation metrics seem relevant again. The new paradigm turned out to be the same old bubble. In 2006 and 2007, I started warning about derivatives and the housing bubble. I called derivatives financial weapons of mass destruction in my 2002 shareholder letter, but the warnings intensified as I watched the housing market spiral into obvious insanity. People were buying homes they couldn't afford with mortgages they didn't understand, and Wall Street was packaging this garbage into supposedly safe securities. They said housing prices never go down nationwide. Well, 2008 showed exactly how well that scientific risk management worked. It worked until the entire system implodes, is when I question artificial intelligence valuations. You don't understand AI, people tell me. This is different. The old rules don't apply. AI is going to change everything. Let me be crystal clear. I don't need to understand the technical intricacies of every AI algorithm to know that paying 400 times earnings for any company is a bad bet. Mathematics doesn't care about your growth story. Mathematics is ruthless if a company is trading at such extreme valuations that it needs decades of perfect execution just to justify today's price. You are gambling. You are playing roulette with your financial future. The AI bubble is real, and it is going to burst. I'm not saying AI isn't important or won't transform industries. It will. The internet was boots. It reshaped virtually every aspect of modern life. But investors who bought internet stocks in 1999 at peak valuations lost. Amazon.com fell 95% from its 2000 peak before eventually becoming one of the world's most valuable companies. Think about that 95%. Could you hold on through a 95% drop? Most people cannot. The technology was revolutionary, but the valuations were insane. Government policy adds another layer of risk that the market seems to be complete. The United States national debt now exceeds our entire GDP. That is not approaching a crisis. That is a crisis. When countries reach these debt levels, they historically have only two choices: default or inflate their way out to formally default, which means inflation becomes the release valve. And what does inflation do to stock valuations? It compresses them. When money loses purchasing power, future earnings are worth less in today's dollars, and high price to earnings ratios contract rapidly. The tariff situation represents another massive uncertainty. In April 2025, President Trump's Shiller CAPE Ratio. Economists estimate that U.S. companies and consumers will collectively pay 77% of these tariffs by the end of 2025, with consumers bearing more than half the burden. This is effectively a massive tax increase on American households at exactly the wrong time, when consumer confidence is already at near record lows. It is pouring gasoline on a fire. The 10 largest companies in the Standard & Poor's 500 account for more than 30% of the index's total market capitalization. This narrow leadership makes the entire market fragile. It is like an inverted pyramid balancing on a very small point. We saw this dynamic play out in November 2025 when tech stocks led a broad market sell-off. Tesla fell 66%, Palantir dropped 65%, and Verical lost 4.15%. All in a single day. The bond market is sending warning signals that equity investors are ignoring. When the April tariff crisis hit, investors initially fled to bonds, pushing yields down, but this flight to safety quickly reversed as bond markets explodes. When both stocks and bonds are selling off simultaneously, there is no safe haven. That is when real panic sets in. That is when the liquidity crunch begins. I have been preparing for this for 3 years. That is why Berkshire has been a net seller of stocks every quarter since 2022. They said I was missing out, but as I have always said, predicting rain doesn't count. Building arcs does. I don't waste time trying to predict exactly when the storm will hit. I make sure we are prepared when it does. Now, Mosher has $382 billion in cash and short-term treasury bills. That is not dead money. It is dry powder. It is huge ammunition. When prices become reasonable again, we will be ready to deploy that capital into truly productive businesses at sensible valuations. We will be the buyers of last resort when everyone else is selling in panic. Every major market crash in history has been preceded by a period of expectavat. This time is different. It is never different. The specific trigger changes. It might be railroad speculation, a housing bubble, technology, stocks, or tariffs. But the underlying psychology and mathematics remain constant. Greed turns to fear, bubbles burst, gravity wins. Let me walk you through the crashes I have witnessed personally, because understanding this history is essential to avoiding disaster. The crash of 1929 is the most famous, and for good reason. On October 28, 1929, the Dow Jones Industrial Average plummeted 13%. The next day it fell another 12%. Within 2 weeks, the Dow had lost nearly half its value. But here is what most people forget. And this is the dangerous part. After that initial crash, the market rallied between November 1929 and April 1930. Stocks recovered a significant portion of their losses. Investors who thought they bought the dip were thrilled. They thought they were geniuses. Then the real devastation began. By July 1932, the Dow had fallen 89%. It took 25 years until 1954 for the index to recover its pre-crash high, what caused the 1929 crash. The same thing causing our current bubble: excessive valuation, widespread speculation, and the 1920s. Stocks were trading at price to earnings, ratios that had never been seen before. People were buying stocks with borrowed money, buying on margin investment trusts. The mutual funds of that era were creating pyramids of leverage when the crash came. Those leveraged positions had to be liquidated, creating a downward spiral that fed on itself. I wasn't alive in 1929, but I experienced Black Monday of October 1987 firsthand. The Dow fell 22.6% in a single day, still the largest single-day percentage decline in history. Portfolio insurance, a supposedly sophisticated financial technique that used derivative. When everyone's computer is programmed to sell at the same triggers, you get cascading crashes. What is interesting about 1987 is how quickly the market recovered. Within 2 years, stocks had regained their pre-crash levels. Why? Because unlike 1929, valuations weren't extraordinarily high before the crash. The crash was driven more by mechanical factors and panic than by fundamental overvaluation. That is not the case today. We have both fundamental overvaluation. We have the worst of both worlds. The dot-com bubble that burst in 2000 offers the most relevant comparison to our current situation. The Nasdaq Composite peaked in March 2000 at over 5,000, driven by speculation in internet and technology. Stocks companies with no earnings and no viable business models were trading at market capitalizations in the billions. Pets.com, an online pet supply retailer, went public in February 2000 at $11 billion. The company had never earned a profit and never would by November 2000. It was bankrupt. That is not an unusual story. It is typical of what happened to hundreds of internet companies. I stayed out of the internet bubble almost entirely. People thought I didn't understand technology. When a company needs to grow at 30% annually for the next 20 years just to justify its current stock price, you are not investing, you are praying. The Nasdaq eventually fell 78% from its peak, and it took 15 years to recover. Many individual stocks never recovered at all. The 2008 financial crisis had different triggers but similar underlying causes. Excessive leverage, misunderstood risks, and the belief that sophisticated financial engineering had somehow repealed the laws of economics. Banks were leveraged 30-to-1 or more, holding supposedly anything but safe when housing prices stopped rising. The entire edifice collapsed. The Standard & Poor's 500 fell 57% from peak to trough. Major financial institutions failed or required government bailouts. It was the worst crisis since the 1930s. I was busy during 2008 and 2009, but not doing what most investors were doing while others were panicking and selling. I was buying in October 2008, right as the crisis reached its peak. I wrote an op-ed for the New York Times with a simple title, Buy American I Am. I explained that bad news is an investor's best friend. It lets you buy a slice of America's future at a marked-down price. Berkshire invested $5 billion in Goldman Sachs, $3 billion in General Electric, and billions thrown out with the trash. Those investments worked out quite well because I was buying good businesses at genuinely cheap prices. That is the critical difference from today's market. In 2009, you could buy the entire Standard & Poor's 500 at 13 times earnings. Quality companies quote, when stocks are cheap, buying during a crash is a great strategy. When stocks are already expensive and then crash, you might be catching a falling knife. You might be buying early in a multi-year decline. The most recent crash was March 2020. When the COVID-19 pandemic in the Standard & Poor's 500 in just 23 trading days. This was the fastest bear market in history. But it was also one of the shortest massive government stimulus and Federal Reserve intervention created a V-shaped recovery. Stocks not only recovered their losses, but roared to new all-time highs. That 2020 experience may have created false confidence among today's investors. They saw a severe crash followed by a rapid attitude that quickly resolved in crashes. But not all crashes are created equal. The 2020 crash occurred when valuations were reasonable. The Fed had ample room to cut interest rates. They were at 1.5% before the crisis, and the government could dramatically increase buys. Interest rates have less room to fall. Government debt exceeds 100% of GDP. And the inflation constraint options, the two-card is empty, the safety net is frayed. Here is a pattern you will notice in all these crashes. They start with denial, move through fear, and end in capitulation in the denial phase. Every dip is bought. Buy the dip becomes a mantra. First, believe that any decline is temporary and represents an opportunity to add to positions at lower prices. This works until it doesn't. Eventually, the declines become severe enough that fear replaces greed. Investors who were buying every dip are suddenly underwater on all their recent purchases. They watched their portfolios, who swore they would never sell, who proclaimed themselves long-term holders, throw in the towel. They can't take any more pain. They sell at the bottom. That is when the real bottom arrives. When the last optimist has given up, I have learned to recognize these phases. Right now, we are still in the denial phase. The April and October crashes were bought. Investors who sold were ridiculed as panic sellers. Don't fight the Fed, people say. Stocks always go up over the long term. These statements are true, but they are also dangerous when prices are already extreme. Yes, stocks do rise over long periods, but the returns from expensive starting valuations. If you buy the Standard & Poor's 500 at a CAPE ratio of 39, history says your returns over the next decade will be approximately 2% annually. That is, before inflation, you are virtually guaranteeing yourself subpar returns. Earnings grow roughly in line with GDP over long periods, about 6 to 7% annually, including inflation. If stocks are priced at 15 times earnings, that 6 to 7% earnings growth translates to similar returns for shareholders. But if stocks are priced at 39 times earnings, you need earnings to grow much faster just to maintain, or you need the P ratio to expand further, which means even more expensive valuations. Neither is sustainable eventually. Valuations revert to historical means. They always have and they always will. It is like gravity. You can defy it for a while with enough thrust, but eventually you come back down. So what should you do with this information? I am not suggesting you sell everything and hide under your bed. I am suggesting you approach the current market with appropriate caution and realistic expectation. If you own stocks today, understand that you are holding them at historically extreme valuations, and your expected returns over the next decade are likely to be disappointing. That is not a prediction. It is stand that you are holding them at his share. First, examine your individual holdings with brutal honesty. Ask yourself, am I holding this stock because of the compelling story or because the business is genuinely worth what I am paying for it? If you own stocks trading at 50, 100, or 200 times earnings, Ask yourself what would need to happen for those valuations to make sense. In most cases, you will realize you are praying for miracles rather than investing based on realistic business fundamentals. Second, build a cash position. I'm not talking about selling everything, but having some dry powder means you can take advantage of opportunities when they arrive, and they will arrive. The April 2025, when quality businesses become available at reasonable prices, you want to be in a position to buy, not forced to sell. As I have said many times, when it is raining gold, reach for a bucket, not a thimble. But you cannot reach for a bucket if your hands are full of overpriced stocks. To focus on businesses with actual earnings, reasonable valuations, and durable competitive advantages. This sounds boring compared to AI stocks promising to change the world, but boring is profitable, boring is safe. Companies that earn real money, pay dividends, and trade at less than 20 times earnings when valuations mean revert. The tortoise beats the hare eventually. Fourth, embrace volatility as opportunity rather than panic. When the market crashes, and it will crash. Remember Rudyard Kipling's line from the poem, If you can keep your head when all about you are losing theirs, yours is the earth and everything that's in it. The investors who profit from crashes are the ones who maintain emotional discipline and act when others are panicking. But you can only do this if you have prepared in advance by maintaining cash and avoiding overvalued positions. Finally, remember that I am not predicting the end of American capitalism or long-term pessimism about stocks. Here, remain as optimistic about America's future as I have ever been. This country has overcome challenges far greater than expensive stock valuations. We survived the Civil War, the Great Depression, 2 World Wars, and the Cold War. American business will continue to innovate, create value, and enrich shareholders over the long term. But there is a huge difference between being optimistic about American business and being willing to pay any price for stocks. It always has and it always will. The biggest stock market crash of the decade has already begun, though most investors do not realize it yet. We have seen the warning shots in April and October 2025, but the main event is still ahead of us. Value in 68 years, consumer sentiment at near record lows, and my own company sitting on $382 billion. These are not random coincidences. They are flashing red lights that most investors are speeding past. I have spent 70 years studying markets and investing in businesses. I have lived through every major crash since 1950, and I am telling you right now, this market is more overvalued than any I have seen except the dot-com bubble. Keep your head when others lose theirs, and remember that the time to build your ark is before the rain starts. The storm is coming, the clouds are black, the wind is howling. The only question remaining is whether you will be ready when the deluge arrives. If you found this analysis topical and want to stay ahead of the financial storm, be sure to subscribe for more deep on it. Thanks for watching.